Does this bear market mean a buying opportunity for crypto investors? The cryptocurrency markets are now experiencing a bear market, and there's no way to sugarcoat the truth that the year has been challenging for the cryptocurrency markets. However, there's a benefit specific to cryptocurrencies that investors may take advantage of. But note that bad markets sometimes result in extremely volatile price movements and losses. Therefore, without doing the required research, one might easily be wrecked during these times. So how do we interpret the current crypto bear market? And will the market survive? Welcome back to Bitcoin Broadcast, one of the best channels for the latest trending cryptocurrency news. If you seek to be updated on what is currently happening in and out of the crypto world, this is the place to be. However, note that we're not financial advisors. This content is just for educational purposes only. Do your own research. And without further ado, let's get started. Cryptocurrency bear markets offer a once-in-a-lifetime chance to not only build up your holdings, but also position yourself to outperform by carefully controlling your risk. The majority of investors, however, really fall short of pulling off such feats during bad markets. This is largely the result of a lack of what a bear market is and of a failure to grasp how knowledgeable investors manage bear markets. But before all these, you need to understand, what is a crypto bear market? In the realm of cryptocurrencies, the term bear market refers to a period of time during which the prices of almost all assets experience a sustained and usually significant decline. Bear markets are common in traditional financial markets, and they're often characterized as occurring when asset prices fall by at least 20% from their most recent highs, and there's widespread discontent with price prospects. A crypto bear market is a comparable decrease in the price of crypto assets on the market as a whole, and it frequently leads to the removal of some projects from the market as they struggle to generate money and fulfill the expectations of investors and users. It's also commonly referred to as the crypto winter. In it, there are some bear market phases. You might be wondering which ones. We gotcha. Many different feelings pass through the minds of investors during the many stages of a bear market. From the first denial of what was obvious to be the case to the unrelenting pursuit of temporary relief to the crushing realization that one had failed completely. A bear market may be broken down into four distinct stages: the preparatory stage, the early stage, the full-fledged stage, and the late stage. The preparatory stage. This is the first phase of a market cycle that begins as soon as the highest price of an asset has been reached. After there's been an extended period of bullishness in the market attitude, players continue to be overconfident in a speedy rebound, even when there's been an initial downturn. This is typically observed in the financing rates of perpetual derivatives, which are driven up when speculators assume leverage long-side bets. When this happens, the rates increase. And as witnessed by most of the crypto assets, there was a jump in financing rates that happened in October last year. This increase took place before the current bear market began. Early stage bear market. During this time frame, there are significant negative swings, but there are also recoveries. The vast majority of market participants are still optimistic that the recovery will proceed to new heights, which results in significant pressure from the purchase side. When looking at charts with a longer time frame, you'll notice that recoveries haven't been able to entirely offset the amplitude of negative moves, which results in massive red candles and comparatively tiny green candles. Full-fledged bear market. This is the most significant phase of a bear market and is characterized by significant downward movement and very little or no upward movement in higher time periods. When investors realize that a market fall is inevitable, they stop rejecting it and instead begin to liquidate significant quantities of their assets. Even while relief rallies can happen on shorter periods like a day, the majority of assets end up retracting 50% of their gains from their peaks over this period. This is despite the fact that large recoveries are uncommon during this time, and during this phase, we've seen companies that are wholly based on blockchain technology lay off employees, and the market then begins to respond negatively to negative news. Late stage bear market. In the later stages of a bear market, market bottoms begin to form, and the rate of market drop begins to decelerate. When the price of an item on the market is low enough to be appealing to a sufficient number of people, the demand side begins to enter the market in big numbers. Despite the fact that there are fewer vendors available, buyers might be more confident that they're paying their assets true value because there are fewer sellers. There is always hope. According to the findings of a new study conducted by Arcane Research, Bitcoin has a significant correlation of 0.5 to both the Nasdaq and the S&P 500. Since the beginning of the year, there haven't been many disruptions to the connection. The collapse of Terra in March caused a rapid exodus, and the second departure was caused by a number of liquidity issues with centralized crypto lenders in the middle of June. And this is where the 4-year market cycle theory comes into play. Market cycles are essentially distinct patterns that frequently result from both the psychology of market players and the larger economic environment. Every market experiences this as a natural occurrence, and the cryptocurrency market is no different. Beginning with little or no market interest, crypto market cycles can occur. However, asset values often increase as interest and demand increase to keep up with the escalating demand. Prices ultimately peak and begin to decline as supply exceeds demand and interest rates start to fall. And at the end of each cycle, a new cycle begins. So how long should a crypto market cycle last? Cryptocurrency has already experienced multiple market cycles despite its short existence. In one of the early market cycles for Bitcoin, which occurred in 2013, the asset moved from $150 in the accumulation phase to over $1,150 at the height of the markup phase in a few months. Eventually, during the markdown period in early 2015, it fell back to $250. The following cycle began in 2017, with a low point of roughly $3,700 at the conclusion of the markdown phase before rising to a peak of nearly $19,000 by the end of the year. In both cases, the asset completed a market cycle in about 4 years, leading to the conclusion that an average crypto market cycle takes 4 years. But then there's the concept of lengthening crypto cycles. The idea of lengthening crypto cycles, which measures the length of each cycle from the absolute bottom to the absolute high of the currency market, also holds that each succeeding cycle lasts longer. For instance, the Bitcoin Genesis cycle lasted just 250 days, the second lasted 750 days, and now the third cycle is expected to last somewhere between 1,350 and 1,400 days. But what does the chart say? More specifically, the Bitcoin Rainbow Chart. The 10 bands on the Bitcoin Rainbow Chart show the price of Bitcoin logarithmically through 10 distinct sentimental levels. The basic concept is that price would oscillate between bands and show potential calls to action, such as selling in a volatile market. Like with other predictive pricing models, neither the upper or lower bands should be breached by the price. If not, the calculations used to determine the placements of the bands must be flawed or at the very least insufficient. The Rainbow Chart predicts that $16,703.48 will be the lowest price in its purple band as of September 2022. The short-term middle-of-the-road HODL scenario shown in yellow is forecast to be around $76,160, while the rainbow price chart shows that Bitcoin might be at $86,790 by the end of the year. Well, this is the perfect time to grab some Bitcoins. That is for investment and at the same time a safe bet. It has the potential to do a 400% return. With all of this, note that none of this is financial advice, so please do your own research. And that's a wrap. Do you think that it's time to buy the dip? And how long do you think the markets will take to rebound to new highs? Comment below, let's interact. Also, please leave a like and subscribe, and don't forget to turn on the notification bell for more amazing cryptocurrency news.